Welcome to The Explainer. Today, we're diving into a tool that tries to answer one of the biggest questions in trading. What is actually happening to drive the price? We're going inside the candle with TradingView's volume footprint charts. We all spend hours staring at these classic price candles, right? But what if you could actually see inside them? What if you knew exactly who was winning the fight between buyers and sellers at every single price point? Well, that's not just a hypothetical. That's exactly what we're going to dig into.
Right. So let's just forget about the simple open, high, low, and close for a minute. We're going way beyond the basics and looking directly inside the guts of the price candle itself.
And the tool that lets us do this is the volume footprint chart. Honestly, the best way to think of it is as an X-ray for a price candle. It literally cracks it open and shows you the exact volume traded at every single price level within its range. This is a huge leap forward in understanding what's happening in the market in real time. Okay, so when you first pull one of these charts up, I get it. It can look a little busy, a little intimidating, but once you know what the key parts are, it's actually pretty simple. So let's decode the anatomy of a footprint candle. Think of each row as a mini tug of war at one specific price. On the left side, you've got the volume from sellers hitting the bid. On the right, you've got the volume from buyers hitting the ask. That highlighted row, usually in white or a different color, that's the point of control. That's where the battle was the most intense, where the most volume was traded. And those horizontal lines, they just mark off the value area, which is where about 70% of all the action happened. It's the candle's real core. And then, right at the very bottom, you get the final scorecard for the whole candle. You'll see the total volume traded, and more importantly, the delta. The delta is super simple. It just subtracts the total sell volume from the total buy volume. It gives you an instant snapshot of who won the overall war for that candle. Now, before we go any farther, there is a super important caveat we have to talk about. A lot of traders look at this and wonder, is this data even accurate? Because TradingView isn't reading the raw order book. Instead, it cleverly calculates it by analyzing price action on lower timeframes. So, what's the deal? Well, the consensus is that it's a very, very good estimation. It's accurate enough for some solid analysis, but it is important to remember you're looking at a sophisticated estimate, not the raw tape itself. So, now that we know how to read the chart, let's get to the good stuff. How we can use it to spot raw, aggressive market action. And we do that by looking for something called imbalances. An imbalance is pretty much what it sounds like. It's a moment where one side, the buyers or the sellers, is so aggressive that they just completely overwhelm the other. The way the chart spots this is really clever. It compares the buy volume at one price with the sell volume at the price diagonally above it. When that ratio gets totally out of whack, it gets flagged as pure aggression. And how out of whack are we talking? Well, you can change this, but a very common setting is 400%. That means for an imbalance to even get flagged, the buyers at one level have to be at least 4 times stronger than the sellers at the next level up, or the other way around. This isn't just a small lead. We're talking about overwhelming, one-sided force. Now, what happens when you see this kind of aggression not just once, but stacked on top of each other, maybe 3, 4, 5 times in a row? That's what we call a stacked imbalance. This is the market practically screaming at you that one side is in total control and is forcefully shoving the price in their direction. Okay, so this brings us to a really common misconception. When you see these big, bold, colorful signals on your chart, what do they actually mean for your trading? Because the obvious answer might not be the right one. So you see it? A big, beautiful stack of green buying imbalances. The price is just rocketing up. That has to mean a flood of new aggressive buyers are jumping into the market, right? I mean, it seems totally obvious. But here's the twist. That's not always what's happening. And just assuming it is can be a very, very expensive mistake. So if it's not a flood of brand new buyers, what else could it possibly be? This is where a critical little piece of nuance in how markets actually work changes everything. So, on the surface, we assume a big buying imbalance means new buyers are aggressively opening up long positions. But there is a second possibility. It could be traders who were short and are now getting squeezed and frantically closing their positions. And how do you close a short? You have to buy to get out. That action looks identical on the chart. It's a market buy order either way.
So what, right? A buy is a buy. Who cares where it came from? The price went up. Why does this tiny distinction matter so much? Here is why it is so unbelievably crucial. If that buying pressure came from short sellers who are now out of the market, they're gone. They have no skin in the game anymore. If the price comes back down to that level, there's nobody left to defend it. But if it was created by new committed buyers, they are still in the market. They're probably going to defend their entry price, which creates support. It is a completely different context.
And this gets to the very heart of order flow analysis. As one analyst put it perfectly, you're really just making an educated estimate. Nothing is ever absolute. Your job isn't to just react to colored boxes on a screen. Your job is to build a compelling hypothesis about what the big players are actually doing. So let's put this all together. How do we take this nuanced understanding of the market and turn it into a practical strategy that can actually give us a genuine edge? Well, first, we have to be realistic about the tool's current limitations, at least on TradingView. Right now, you can't filter out the tiny, meaningless imbalances. It also doesn't ignore imbalances against zero volume, which isn't very helpful. Plus, for crypto traders, it lacks open interest data, which would help you confirm if the volume is from new positions. Because of these limitations, using a purely mechanical if this, then that approach is a really bad idea. This all leads us to a much smarter strategy. Okay, step 1. You spot the stacked imbalances on the chart. And this is the absolute key, you do not just trade it. Instead, you mark that area as a level of interest. Then, you do the hardest part in all of trading. You wait. You patiently wait for price to return to that level. And finally, you observe. How does the market react there? Does it find support and bounce? Only if the price action confirms your hypothesis do you even consider taking a trade with your own entry system. This isn't about taking signals, it's about curating the chart to find the most important battlegrounds. So I'll leave you with this one question. The footprint chart gives you this incredible amount of information. Are you just going to read the numbers on the screen, or are you going to step back and ask, what story is this volume telling me? Answering that question, well, that's the difference between being a novice and a pro. Thanks for joining us on The Explainer.